Hello, welcome guys to Trade with Popper. Today we are going to be doing an introduction into price action concepts. Let's get right into it. What is price action? Price action refers to the study of historical price movement in the foreign exchange market to make trading decisions. It is the action of price. Traders who use price action analysis observe and interpret the price movement on charts to identify trends, key support areas, key resistance level, and other signals that can help them predict future movement of price. To simply put, price action is price responding to itself. So if you can read price and you can see what price did before, you can tell what price would respond to when it comes to a particular level in the future. This is known as market structure, order flow. You'll get to know more about it as we go. What are highs and lows in Forex? In this context, highs and lows refers to specific price level reached by an asset or pair during a given period of time, such as a day, a week, a month, or even a single trading session. It can be in 4 hours, in 8 hours, it can be in 12 hours, whatever time frame you decide to use to look for the high and low, you can find it. Think of high and low as the value data that will begin to help us to understand the construct of the market. It's very important data in understanding order flow. Now we're going to talk about higher highs and higher lows. In the market, there is a constant repetition of highs and lows as price fluctuates and assets are exchanged. Through this continual series of highs and lows, this is where higher highs and higher lows are formed. Now, what's a higher high? Higher high is when the highest price point in the current market period is higher than the previous highest price. It is called a higher high. What's an higher low? Higher low is when the lowest price in the current market period is higher than the previous lowest price. It's called higher low. As you can see in this diagram to your right, the market started from a low point, made a high point, and then made a low that was higher than the previous low. Then it became higher low. Then it went up higher than the previous high. Then it became higher high. Then it came down and made a low that is higher than the previous low. Then it became a higher low. And it just continues to go like that until it breaks this flow. Now, it's important to note that when the order flow in the market is bullish, is where you see the market form higher highs and higher low. So when you see higher highs and higher low in the market, there is a bullish formation for market structure for order flow. Order flow is market structure. When you see that kind of a formation, you know this market is bullish. So you want to favor more buys than sells. Now, what are lower lows and lower highs? This is the exact opposite of what we just spoke about. This is the formation of a bearish trend. As you know, the market is a constant repetition of highs and lows as price fluctuates and assets exchange. Through this continual series of highs and lows, there is where lower highs and lower lows will be formed. Lower highs are when the highest price point in the current market period is lower than the previous highest price. It's called a lower high. And lower low, same thing. When the lowest price in the current period is lower than the previous lowest price, it's called a lower low. It's a formation for a bearish trend. You see where market is making a high, a low, a lower high, a lower low, a lower high, a lower low, as you can see in the image to my right. This is the formation for a bearish order flow. It's a bearish trend. Favor more sales in this kind of market structure. So this is how you start to identify what to do when you see a particular type of order flow. What do I want to do in this market now? Do I want to sell or do I want to buy? I'm seeing the order flow is pointing downward, so I want to sell. So I'll be waiting for price to come up to a higher price point so I can get a nice sell entry. That's simply what lower lows and lower highs means. They only form in a bearish trend. Only in a bearish trend. You will not find it in a bullish trend, except if it's a correctional move. You would learn about that. On to the next. What are trend lines and channels? They are tools used by traders to identify and visualize trends in the financial market. They help traders make decisions based on the direction and strength of the market. You never want to trade against the market. You want to trade in the direction of the market. So if the market is pointing upwards, you want to continue to follow that rhythm. If the market is pointing downwards, you want to follow that rhythm. You do not want to trade against the market, else you would lose. Now, a trend line is a straight line that connects not more than 2 points on a chart, and it's used to represent the direction and slope of a trend. While a channel is formed by drawing two parallel trend lines, this creates a channel that contains price movement within defined boundaries. As you can see in the image on my right, there's a trend line at the bottom and then a parallel line on the top, forming as a channel resistance. You understand? So the trend line at the bottom is forming a slope up resistance support. The one at the top is forming a resistance. And you can see price is moving up and down, up and down. The order flow is up and down inside this channel. Now let's talk about pullbacks and correction. Pullback or correction refers to price reversal within a prevailing trend before potentially resuming its original direction. Traders often use pullbacks and correction as opportunities to enter trades in the direction of the overall trend at a better price point. Very important. That's the essence of waiting for a pullback, because you will get in at a better price point. For example, the price of a land is being sold for 3 million because there's a current surge in the market, in the land market, and then it used to be 1.5, and you just decide to wait till it's around 2 million before you buy. When you wait for a pullback in the price of that land, like you get land for 2 million, you waited for it to pull back from 3 million to 2 million, and then you bought at 2 million, and now you can ride it up as the value appreciates to 4 million, 5 million, 6 million. You understand what pullbacks are now? I think that's best explanation for it. So a pullback refers to a temporary reversal in the direction of the prevailing trend. It occurs when the price moves against the trend. Correction. Now, corrections are more significant price movement against prevailing trend. Corrections are usually larger and last longer than pullback. They are known as temporary trend interruptions. Any market move against the prevailing trend is known as a pullback or a correction, depending on how long it lasts. Now let's talk about support and resistance. Support and resistance levels help traders identify potential entry and exit points for their trades. These levels are not fixed and can be changed over time based on market dynamics, but they provide valuable insights into market behavior and indicate a point where buying and selling interest tends to increase. A support refers to a price level at which a currency pair historically has had difficulty falling below, and it acts as a floor for the price. Resistance, on the other hand, refers to a price level at which a currency pair has had historical difficulty rising above that point. In this case, it acts as a ceiling. Looking to the image on my right, you would see that in this uptrend, we had a resistance level, which is a key level of interest. The minute price broke above it, it flipped it. This is price action. Now, it was a resistance in the past. Now it became a support, because since price had difficulty breaking above it, the next time price breaks above it, price would most likely come there and find a base to launch from there. So support and resistance levels are basically launch pads for price to move off of. And they can be used interchangeably, meaning when price is above it, it's a support. When price is below that same key level, it's a resistance. So it's not a different level, it's the same thing, but depending on where price is in relation to the level. Let's talk about consolidation and contraction. Consolidation in forex markets refers to a period when price of a currency moves within a relatively tight range, showing little or no trend movement. It's just moving in a sideways manner. You can say it's moving in a sideways channel because it's just going up and coming down. It's not going up and making higher highs or making lower lows. It's just making equal highs and equal lows. You tend to call this kind of a market consolidating. It's not trending up, it's not trending down. It's just trending sideways. You call that kind of a market a consolidation market. Now, contraction, on the other hand, is a form of consolidation. In this kind of market condition, you might observe reduced trading volumes and decreased market volatility. It's not moving as much as it ought to be moving. This situation often precedes a significant price movement. Immediately after there's a contraction, there's usually a significant impulse to the up or downside depending on the order flow. As you can see in the image on my right, the top part of the chart, you notice price was contracting in line with the trend, contracting. The only kind of movement that can precede that kind of contraction is a large impulsive buy movement. So generally, when market is in contraction mode, consolidation mode, it's said that market is in indecision mode because it's not going up or it's not going down, it's just moving sideways. You cannot tell if it's going up or going down, it's moving sideways, it's in decision mode. Most traders stay out of this kind of market conditions because they cannot tell the trend clearly. And it's advised until you're a pro trader, you should also stay out of it. On to the next, understanding market structure. Same as understanding order flow, the buys and sells in the market. Market structure refers to the structure of the market. It is a commonly used term by traders who are able to identify the series of highs and lows to detect the current market trend and change in trends and utilize the data gotten from this detection to make informed trading decisions. Additionally, market structure will help a trader identify when the market is ranging, consolidation mode, trading within a trend or channel, approaching key levels such as support and resistance, and many more. As you can see in the image to my right, there is a low, there is a high, there is a higher low, there's a higher high, higher low, higher high, and then we can observe that trend change made a lower low, lower low, from a higher low to a lower low, then lower high, lower. This is key point data that you'll be able to read in the market when you understand order flow, when you understand market structure. Now that I've been able to explain this concept, I want to take us over to the chart so I can show us how it would look in a real life chart. Let's get right into that. So guys, we are on the GU chart, 1 hour time frame, and here we'll be going over all the concepts we explained. So currently on this chart, we can see that the highest price point is here. Here's the highest price point on this chart, and here is the lowest price point. So you can say this is the high and this is the low point for GU in this between what? Monday, let's say between Monday or Tuesday 22nd of August to Thursday 23rd November 2023. The highest price point for GU is 128,006, and the lowest price point is 120,362. Highs and lows. Now this is on a broader level, but for every time the market moved, like from this high, it made a low, then a lower high, then a lower low, then a lower high, then a lower low, then a lower high, then a lower low, then made a lower high, then it made a low, higher high, higher low, higher high, higher low, higher high, higher low. Then here it switched high, low, high, lower low, lower high, lower low, lower high, lower low, lower high. This is market structure, guys. So let us make this bearish trend formation. High, low, higher low, lower high rather, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. Here you have your bearish trend formation, because we can see that the market is creating series of lower lows and lower highs. We can see the market is bearish, so we want to look for more sells. See? And I want you to understand that inside a given structure, there are other substructures. Like for example, in this scenario where I did this low, high, low, lower high, lower low, lower high, and then I just, the previous step, I just took this from here to straight here. But this is substructures, and then it ranged here, just moved, still trading in between this high and this low, range until it broke out here. Broke out. So this here is a substructure in the overall structure of the market. This here is a pullback. This here is a correction, more of a correction than a pullback, because this move took from Friday till Wednesday. So this is a very long move in the opposite. This is a very, very long move against the trend. So you would say this is a correction, and then the original trend resumed. Low, lower high, lower 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 low, lower high. You can do this. Lower low, lower high, lower low, lower high, lower low. Yeah. Now we have what? Higher high. Order flow is changing. Order flow is changing. So we're going to put in a higher low somewhere. So you can see it. This you're reading it. Okay, it's lower low, lower high. So it's bearish. I should look for more sells. And here, the minute you notice that the order flow is changing, and you have a higher high from a lower low, from a lower high, lower low to a higher high, then order flow is changing. So you want to look for the lower low so you can take price higher. And as you can see, price did go higher. Price did go higher. Broke above this previous high. And there you have it. Higher high. And then we continued. Higher low. Higher high. Higher low. Higher high. Higher low. Higher high. higher low, ranged, lower low. Structure is changing, order flow is changing. So it means what? Look for more sells. This is higher low, so it's most likely going to put in a lower high and do what? And drop. Give us a lower low. Do you understand now? Good. So that is all for highs, lower lows, lower highs, higher lows, higher highs. I think you get the point now. Now let's talk about support and resistance. While I don't like to trade the traditional support and resistance, which is looking for areas like here where price refuses to break above, so that when price breaks above it, finally it's going to come back, retest it and buy. Yes, it's going to always buy, but not at this point. So now traders will be expecting something like this, because that's how you see it in the textbook, but you're not going to get that. And that's why most traders will lose, because they're expecting to do something like this. But see, in this scenario now, market did not react off of this previous resistance. It dropped deeper into the resistance and then launched from there. That's why I don't like trading this kind of support and resistance. The kind of support and resistance I like to trade is the one that the order flow gives me. So for example, in this scenario, I have order flow created support here from that red candle. I have order flow created resistance here. So instead of trading this breakout, instead of trading the breakout from here and saying when it comes here, it's going to retest it and buy it, I would rather wait for markets to come from here all the way down to this order flow, because this here is another block. The last red candle before the bullish move, this is another block. Wait for price to come here. This is my support now. And look how when price got to that other block, it found a nice support and launched from there. You want to know more about order block? I made a video. It's in the price action concept mastery playlist. Go check out order blocks. There are other blocks, there are mitigation blocks, there are breaker blocks, and there is the drop based drop, rally based rally. Those kind of support and resistance are the ones you want to buy and sell from, not the traditional one, ceilings and roof. Do you understand? So that's it on support and resistance. That's it on support and resistance. Let's talk about consolidation and contraction. Yeah, let's talk about consolidation and contraction. So contraction, yeah, this is a perfect example for contraction. See how price was going up in this uptrend, and then now if you were to draw a parallel trend line, it would be like this. But instead, you notice the price, instead of moving in an expansionary manner, it started to contract. And like I said in the slides before now, that after a contraction, there's usually large impulse move, either to the upside or downside. In this scenario, the large impulse move was to the downside. Look how, like, immediately after this contraction, this small movements contraction. Look at what we got immediately after that contraction. Now, all of these examples, like the contraction will not be textbook like it was explained to you, but it's just so you can understand the concept of a contraction. When you understand the concept of contraction, you can apply it on any price chart you see, because you understand the concept. Okay, this price is starting to narrow down. It's no longer trading large, it's starting to narrow down. And here in this scenario, you can say markets moved in a range. You can say this is a range. Made a low, made a high, and then never broke above the low and high it made. It was just trading sideways. See? You say high, then it's just started trading sideways inside this sideways channel. But the minute it did this, it was an indication that order flow is changing. It's no longer trading sideways, broke out, look for buys. Can you see that? And now I'm looking for buys. I've like even the previous example, I showed you how I got this. Okay, this is where I want to buy from, right? So since you have seen this, the next place you're looking to buy from now is from your support. Where is your support on this and this buy move? You see, okay, this is a support here. Okay, I want to buy from here. When it gets there, I want to buy from here. And then it gets there, you buy from there. And look, launches, comes back down, launches, comes back down. You also be looking for supports, not the traditional one, but the order flow created supports and resistance. Here now it reacted off of the mitigation block. Supports. There's a mitigation block support in this area. That's where it's reacted off of. You would know that, okay, so this is where I want to buy from next. Then here it's also reacted off of a mitigation block support. So this is how you see order flow change, or you know where you buy your support to buy from, your resistance to sell from. So in this example, I've explained contraction, consolidation, and break out of consolidation to continue order flow to the upside or downside. After you see a consolidation like this, price can either break above or break below, but whatever it decides to do, you know that based on the order flow, you are going to look for continuation in that direction. So breaks to the upside, continuation to the upside. Breaks to the downside, continuation to the downside. As simple as that. It's not rocket science. It's what you see, you are reading. That is price action. Price reacting to itself. Price action. Price reacting to itself. So you have seen price break out of a previous. Okay, so it means price will react in this direction. Then I want to look for more buys. This is the entire concept of price action. So now that is done, let's show you market structure switching from a downtrend to a buy trend. Here we have a series of lower lows, lower highs, lower lows, lower highs. I'm just summarizing everything here because there are a series of minute movements here, but you get the point. And here, from a lower low, we made a higher high, and then higher low, higher high, higher low, higher high, higher low, higher high. You can see here we change from a sell trend. That's how you get your change of character. Change from a sell trend to a buy trend. And we started breaking structure to the upside. This is market structure. We broke the previous market structure to the upside. BOS buy. We'll look for more buys. The more you break structure, the more you look for more buys in that direction. So break structure again, more buys. Break structure again, more buys. So I think you get the point now. Now you have to master all of these concepts to be able to identify when to buy or when to sell. That is the game of Forex, knowing when to buy to make profit, knowing when to sell to make profit. And in order to do that, you need to understand all of these concepts, the price action concept. So it requires mastery, and that's what you are headed towards. Master this concept, and you will know when to buy, when not to buy, when to sell, when not to sell, when to exit your buys, when to exit your sells. Thank you, guys. Thank you so much for watching, guys. Subscribe. Don't forget to like, comment, and share this video.